Help capture the history of our markets by contributing to the John Lothian News GoFundMe campaign to support the Markets Wiki Education history-focused video series and more.
Advantage Futures is proud to sponsor JLN Video Series.
Many include a recurring theme of people helping others during critical times in their trading careers.
Too often today, when traders need help the most, their call is met with numbers to press on the phone instead of an actual person.
Advantage prioritizes you.
Personalized service, competitive pricing, aimed at giving you every advantage.
Make us your advantage.
Advantage Futures.
I started out not trading, but doing the risk management and being the CFO for the Goldberg Brothers before I actually started trading. Being the risk manager and having to go over trading with traders every day and risk, basically when the Midwest Stock Exchange went into options, they gave me an extra seat that they had. I traded over there, and I also brought in quite a few customers when it started. And from there, I moved up to the CBOE in I think 76, and I bought my own seat in the summer of 76. The sky was the limit. We had some people that made incredible sums of money. Irv Kessler started with us at 21 years old, and I think his last company sold for $185 million or something like that. Because one of the things on the securities side was you weren't just a scalper or a scalp spreader or whatever your category of trader was. You were in a lot of cases you were building up organizations. They were training clerks and then backing clerks, and the clerks became a part of their organization, and so on and so forth. In 87 in October, the orders were flying in. I was actually on the executive committee of the CBOE. So I got pulled out a lot to make decisions like to shut down. We had rules about if a certain number of stocks had shut down because of order flow, we had to restart. We had to go through an opening rotation and things like that, which hopefully people will understand the terminology. And that day, I think during that day, I made about $280,000, mostly what I would call scalp spreading. I was helping out, if you call it that. I don't know if I helping out. I was trying to make money. And I went down to trade bond options. And I was actually decent at it. And every day I would trade and scalp a little bit. I'd make some money, try to leave flat. And this one particular day, I remember that at the close, I was short puts, and the market was rallying pretty good, and the puts weren't going down. And it was a trade. I think it was a I don't know, 26 lot or a 28. It wasn't a huge quantity, but it was, I'd been there too many times before as a trader. And I said, I've seen this on the close where they're marking them up because everybody's short and I'm short, and I'll wait till tomorrow and I'll buy them back on the opening. And what happened was I guess market sense was going on. I didn't, my 36 lot or whatever it was, it opened up and the market in bonds started to crash, and I was short puts. And that little trade, I was out $86,000 a day later. I wound up giving it to a broker, Jack Brogan, whose name I will mention, one of the most honorable people I've ever done business with. I gave it to Jack and I said, look, I'm too emotionally involved. I can't get out of this myself. Every time I go to pull the trigger, I'm changing my mind. Just get me out. And that day, I watched them from my office, and instead of being down 86,000 in the morning, I was down about 50, which I thought was really a big benefit. And I went down there with about 10 minutes to go. I stood in the back of the crowd, and I made signs like how many, and I indicated to Jack, and Jack goes like this, 0. And after the market closes, I talked to him, and he says, look, I'm watching it. Good friend of mine, wonderful person. Didn't buy anything back. Next morning, it goes my way again. I go down there. He says, I got it. Don't worry about it. I'll make sure. Well, I think it was Friday. As soon as he got me out, the market turned around and fell again. We were close to in the money at that point. And he did the best job any human being could have possibly done. So I had a little piece of that. On the first floor of the Board of Trade was a store called Audio Video Option. I went in there, told the guy to send Jack a Mitsubishi TV set, and Jack wouldn't take it. He had a place in the Quad Cities, I know, and he wouldn't take it. And so I went across the hall to the travel agency, put 2 tickets to Hawaii in his pocket, and he wouldn't take those either. I don't even know if he got the brokerage for the whatever the trade was, 30 a lot or whatever it was. I'm assuming it just came out of my account. But that was my worst day. My worst experience was a couple-day period. I got caught on a shutdown in a stock where there was news coming out, and I was a small debit. It wasn't a lot. It was probably $5,000 or so, but it was a lot of money to me at that time. And I went to bring a check in, and Dave Goldberg, who now changed roles, he was the risk manager for me. He said, I don't want your check. I said, what do you mean you don't want my check? I think we could even trade with debits. He says, I want you to bring in a check every day for $500 a day. And I go, why would you want to do that? He says, because when you write one check, it hurts once. When you have to write every day, you're motivated to make money. That's what I did. I brought in checks until my debit was cleared up. I never traded with any money in my account to begin with, because it was in Dave's mind, it was more disciplined. Some traders need to have a lot of money in their account to be secure about their trading. Other people, Peter Stottlemyre, good example, traded through us for years. Wonderful man, honest person, very successful. And Peter would draw to a deficit on the Board of Trade. And then because he felt more motivated when he owed us money to get back to zero. So he'd go to a $75,000 deficit and then trade it back to zero and take money out again. And it was fine with us. At the beginning, it was try to go down there and be a scalper wherever I was. Try to get flat and make a couple of bucks and leave the floor. As time went on, as I said earlier, it became more difficult. So I became more of a spreader. And I really, when puts came in, I became more of a specialist in puts for some reason. Actually, we hired, trying to remember if it was the 2 guys that invented the equation for the
Black-Scholes.
Yeah, Black-Scholes. We had Black. I hired him. We hired him to come and give a lecture to our traders after the close about puts, because no one knew too much about puts, and he was the mathematical expert. And so I went to lunch with him that day at one of the places, the Metropolitan Club or something, where it was quiet, and we spoke a lot. And I got to ask him the questions that people would want to ask somebody like that at that time, like, what would you do if you traded? And he said, I don't trade. I make too much money in royalties from the equation. He said, but what I wouldn't do is sell out of the money options naked. And I said, why? He said, well, it's the mathematical equivalent of betting red or black in roulette and doubling up when you're wrong. You'll make a little bit of money a lot of the time, but when you go out, you'll go out big, because that red or the other number will come up mathematically, 6 or 7 times in a row or whatever, and you're doubling up each time will cost you a lot more money. So I remember walking away thinking about that. I remember one trader came into me. He was from Madagascar, and he had a very thick Cockney accent. And he said, and I told him why his position was too risky and what he had to do to pare it down to be in relation to his net worth in his account, his equity. And he said to me, mate, you don't understand it. I'm trading Bund options, and I get the information before Germany does, and this can't happen, that can't happen. And I remember saying to him that, what do you think the probability, how many standard deviations do you move out? Everybody was mathematically oriented. It was already 1987. And he said to me, it can't happen. And I said, let's assume that it can happen, but it'll only happen 1/10 of 1%. And he says, okay, I agree with that. I said, Now let's talk about what 1/10 of 1% really means. It's 1 out of 1,000, correct? He goes, yeah, it can't happen. 1 out of 1,000. I go, no. There's 250 trading days in a year. And if it happens 1 out of 1,000, it happens once every 4 years. And that's not that remote. And he said, okay, but I can't stay here. I need to sell. They were basically selling out of the money puts against what are called conversions. Again, I don't know your familiarity or the audience's familiarity, but it's an option strategy that's set up to create a rate of return that's better than the cost of money. I got rid of him. He blew out. He took the bank sub, one of the other banks in London that was clearing, and they shut up business. They shut down, which gave us the opportunity to raise rates at the beginning of 1988, and also make some acquisitions that were pretty good for the bank. At one point, ICS had 500 employees. From when I went there, they had a basement with a half a dozen people. I remember the Challenger like it was yesterday. We were on the CBOE floor before they moved across the street to the floor they're at now, and it got silent. The entire trading floor was silent. The 87 crash was very weird because we kept having to stop and start, and I'd get pulled out of trading and things like that. And brokers, it turned out some of the big brokerage firms like Merrill, they would give their brokers just the buy or the sell side of puts. So you knew exactly what they had and, try and cut down on the amount of errors. In 1976, we had a couple of really big days. I think it was in April. And our operations, Merrill Lynch and us, we didn't gel. And Merrill Lynch had literally thousands of out trades the next day. And we paired off as many as we could. And we talked to the people at Merrill and the head of operations at Merrill. And I remember at 11 o'clock at night trying to get him to take the trades with Joe Sullivan and whoever. I think Ed Neal might have been chairman at the time, believe it or not. And we were on the phone with him. And in so many words, he said, we're bigger than you are. Fuck your exchange. And, blah, blah, blah. He wasn't real happy with the fact that we were telling him to take a big chunk of money. And it took a couple more days of negotiating to basically get it straightened out. And a lot of crazy traders who knew trades were good, who weren't getting them. We had them on the statements correctly, but we weren't balancing. We were out at the clearinghouse and things like that. So it was a very, very weird time. We didn't know really whether we were going to make it or not. There were so many things going on. I also spent a lot of time working on the rules to determine. The SEC came to us and they said, we got a problem here. You can have a clearing firm with $1 million in it and at one guy's account, and then there could be 10 people who come out to $1 million worth of risk who have no equity. And the way we were computing things, goes back to the beginning of the CBOE, they would get lumped together, which wasn't realistic, because if the guy wanted his money out, you had to give it to him, and now you're stuck with a clearing firm with all this risk. So we invented a system. It was Jim Bruckey and Joe Sullivan and I that basically looked at, we didn't have the computer ability to do it, but looked at the system I was using to pair off options and see what the excess risk was, added up, and it had to be able to be done at night. So you couldn't use theoretical values because nobody had the computing power to figure out what the worst loss would be over a 3 standard deviation move like they do now. So we couldn't do a risk-based system. So we had to do one that was sort of gerrymandered or jury, whatever it was, we jury rigged it. And it held until 1999. And I wrote that, and that was a lot of back and forth with firms from New York trying to get an advantage to move business to the Amex by changing the capital rules and things like that. So we had a very interesting period. Also, there was a time when the firms were deciding where to direct their order flow based on volume. So between the Amex and the CBOE, there was a war that started. This was pretty early on, to try and get the volume up artificially, which isn't correct, so that the order flow would be moved by the major wirehouses to one exchange or the other. So we went through a lot of evolution.
Advantage Futures is proud to sponsor this JLN video series. In many of the series videos, there are recurring themes of people being helped at critical times in their trading careers. Too often today, when traders need help the most, their call is met with numbers to press on the phone instead of an actual person. At Advantage, you are our priority. Everyone needs an edge or advantage when trading. Make us your advantage.
John Lothian News would like to thank those individuals who have contributed to our Markets Wiki Education GoFundMe campaign. Their financial assistance allows us to produce and distribute videos like this for our Open Outcry Traders History Project or the Path to Electronic Trading video series. Join them in supporting John Lothian News, capturing the history of our industry.